Hi all, myself Dr. Ibha Rani from Kristu Jayanti deemed to be University. In this session, I will be discussing about the risk and return, which is very important concept in the investment management. And also as an investor, you should understand what do you mean by risk and how the risk is associated with the particular return. So today's agenda of this class is introduction to investment return. What do you mean by risk return trade off in investment decisions? Calculation of expected return and how to calculate if it is given the returns and probability have been given, and if it is only returns have been provided. So we will look these formulas and with the one of the illustration. So now first we will understand what do you mean by risk. So in finance, because we are looking into the financial perspective, so in finance, risk refers to the degree of uncertainty or potential financial loss inherent in an investment decision. So when you will look into the terms risk, it means that it is the degree of uncertainty. Means I am expecting, I have invested in any of the investment avenues, maybe share market, maybe debentures, maybe bond. So I am expecting certain return from this investment options. Are am I able to get it whatever my expectation is there or not? Or what is the uncertainty of my return if I am expecting that my return from this investment should be 10%? Am I able to get it 10% or not? That is only the risk is there. So it can be uh, uh, profit also, potential profit it can be, or it can be potential loss as well. So, but when you are calculating the risk, we are looking into only the loss, how to compensate those loss. So that's why the risk is the degree of uncertainty which will be associated with your investment decision. In general, as an investors or as a investors, always you want to avoid risk. That's why investors are risk investment risk rises, and as an investors we want to, or we expect higher returns to compensate for taking such a risk. So risk is the difference between the expected return and the actual returns. So if I'm expecting that 10% return from this investment options, but I'm not able to get it 10% return, in actual maybe I'm getting more than this, or maybe I'm getting less than 10%. So any difference between the expected return and the actual returns what I'm getting from this investment option is only the risk. So in simple terms, risk is the difference what we are expecting and what actually we are getting it, that is only the known as the risk. Now the next term is coming, risk return trade off. Here trade off is means striking a balance, balancing the both risk and return. Look into this figure here. If you will look into this, you can see that return is on the y axis and the risk is on x axis. Always the risk will be calculated in terms of standard deviation. You have learned or you have heard about the term standard deviation in statistics also, how to calculate this standard deviation. So whenever the questions will be asked how to calculate the risk, so risk will be calculated in terms of standard deviation. This side on x axis, on y axis, you can see the term return or percentage of return you are expecting from any investment options. Now here trade off is talking about how to manage your return with compensation of the risk. That is only talks about it depends on the types of the investor. You want to take high risk or you want to take it low risk. So risk will be calculated in terms of standard deviation. Here you look into that. Here the first thing is lower risk is associated with the lower potential return, and higher risk will be the compensated by the higher potential return. So as an investors, we have to make a balance between how much return I am expecting, so that return will be compensated with some extent of risk. High return if I am expecting, the chances of risk also will be high, and your high risk will be compensated with the high return. So as an investors, you will be having the options to select those investment options which make a balance between the risk and return. Now, as an investors, how to calculate the first we will learn about the expected return. So here what is the expected return? So it is the amount of profit or loss an investor can anticipate receiving on an investment. You are predicting that from this investment options I am getting 10%, 20% or some returns. That is only known as the expected return. Now, as an student of investment management or as an investor, you need to calculate your expected return. So now expected return can be calculated based on the two formulas are there. One, when the probability you know that the chances of return is this much with this probability is there, then the formula is different. So the first I am discussing how to calculate the expected risk when the return and probability have been provided. So expected return will be your return R1 multiplied by the probability plus R2 into probability plus R3 into probability till the number of chances it will be. So the expected return will be calculated as the sum of the returned multiplied by the probability, or expected return. Here you can see in the PPT it is summation of R into P. And risk, now return, expected return, what do you mean by risk? Risk is the variability in the return, how much I am expecting and how much I am getting, that variation only known as the risk, and it will be calculated in terms of standard deviation, or it is also known as variance. Variance is nothing but square of standard deviation is known as variance. Now, how to calculate this risk in terms of standard deviation? So, standard deviation, the formula is root of r minus er square multiplied by p, or the formula it will be the standard deviation root of r minus expected return, sometimes it will be, or it is the mean or average return. That's why the sometimes in somewhere if you will look into the formula you will be getting this formula all as well. So it is both expected return or r average or mean return it is. So r minus r square multiplied by the probability. So this is the first formula when the probability have been given. So expected return will be r into p, summation of r into p, and standard deviation will be root of summation of r minus r square multiplied by the p, and variance is the square of standard. Now we will look into the second formula where the probability we do not have the idea about the probability, that what is the probability of getting this return. So now it is the when only returns have been given. So expected return, because we do not have the probability, so expected return will be calculated as R1 plus R2 plus R3 till Rn, number of observation. So expected return formula R average or R mean return or expected return will be the summation of R by N, where N is the number of observation, number of chances they have mentioned in questions. So R or expected return will be summation of R by N. Again, the risk refers to the variability in the return. If there is no probability, how to calculate the standard deviation? So the formula of standard deviation is summation of r minus er squared divided by n. Always whenever the probability will be there, probability will be considered as 1. So here standard deviation will be here, instead of probability it will be divided by the number of observation. Other than that the calculation will be same only. So now I hope you understood with both the formulas. Now I'll be discussing about one of the problems, how the problems will be asked in the exams. So here it is the calculate the, for example, calculate the return and the standard deviation of return for a stock having the following probability distribution of return. So here possible returns they have given you and the probability of occurrence. The chances that minus 25% I am getting the return is 0.05, and like this the questions have been asked. Now first we calculate the expected return and based, as in this questions probability also have been given, so the expected return we will be considered the formula of return multiplied by the probability and the summation of this. So expected return, this will be the formula. Now the return have been given in the questions, which is minus 25, minus 10, 0, 10, 15, 20, 30 and 35, and the occurrence, the chances of that particular return associated with minus 25 is 0.05, 0.1, like this they have given you. So first we will be calculating the expected return. Expected return will be calculated as return multiplied by the probability. So minus 25 multiplied by 0.05, which is giving you minus 1.25, minus 10 multiplied by 0.1, minus 1. 0, if you multiply any value it will give you 0 value only. Then 15, 15 ja 25, 225, so it is 2.25. Like this I have multiplied here in this column, so the third column, which is probability into return. So I have multiplied, added all those value, I got it, the expected return is the 16.25%. So our expected return we have calculated it. So which have been calculated by multiplying your return with your probability and adding all those value will give you the expected return. Now we have to calculate the standard deviation. What is the formula of standard deviation? Here it will be summation of r minus er square multiplied by P. Now you can see here, this is the format you have to remember it. R they will give you in the questions, probability have been given in the questions. Now the product, just we have calculated it, the expected return is 16.25, we have just now calculated in previous slide. Now this is the table you should remember when you are calculating the standard deviation. It is the r minus r average, then r minus r square, then r minus r square multiplied by the probability. So this three column you should remember it how to calculate. Till 16 now I got it, this 16.25 was our expected return. So first return is minus 25 minus 16.25, because the first column talks about r should be, return should be subtracted by your expected return, and in this questions the expected return is 16.25. That's why minus 25 minus 16.25 is minus 41.25, minus 10 minus 16.25 is minus 26.25. Like this I have calculated for all the return. Then next will be the square of this value, which is the square of 41.25 ka square, which have come. Calculate it, you will get it 1701.563 minus 26.25 multiplied by minus 26.25, minus value will be plus after multiplication. So like this I have multiplied in this column. Then this value should be multiplied by with the probability, means 1701.56 should be multiplied by the 0.05. So here 85.02, 68.91, so we got it the all the values. When we have added this, so standard deviation is the root of summation of r minus r square into probability. So we have calculated and added those value. So standard deviation will be the root of 274.69. So standard deviation is 16.57%. So thank you so much. I hope you could have understood the concept of risk and return and how to calculate it if the probability have been given, and what is the formula you have to apply, and what is the without probability how to solve and how to calculate it, both the risk and expected return. So thank you so much. Take care. In the next video, I'll be coming with the new concepts. Thank you.